Major stock market events and crashes in last 120 years. Over the past 120 years, there have been numerous financial crises and market events that caused significant losses and turmoil for investors globally. Understanding these events can help prevent similar mistakes in the future. Here's a list of some of the biggest market crashes and crises, their causes, and how investors can avoid such risks going forward. Major stock market events and crashes. 1. Panic of 1907. What happened? The stock market crashed by nearly 50% due to failed speculation, which led to a liquidity crisis. There was a run on banks as people feared their deposits were unsafe, causing widespread panic. Cause: lack of a central banking system to provide liquidity and speculation-driven market activity. How to avoid? Ensure regulatory mechanisms are in place to monitor excessive risk-taking by financial institutions and ensure strong liquidity management. 2. The Great Depression, 1929-1939. What happened? The 1929 Wall Street crash wiped out billions of dollars in wealth and triggered the Great Depression. The market fell nearly 90% from its peak over a few years, leaving millions unemployed and businesses bankrupt. Cause: excessive speculation, high leverage, overvaluation of stocks, and a lack of financial regulation. How to avoid? Avoid speculative bubbles, over-leveraging, and be cautious of overvalued assets. Diversify portfolios and invest for the long term, rather than chasing quick profits. 3. The 1973 to 1974 stock market crash. What happened? The oil embargo led to a quadrupling of oil prices, skyrocketing inflation, and an economic downturn. Stock markets in the US and Europe fell by over 45%, leading to widespread losses. Cause: the oil crisis, coupled with high inflation and economic stagnation, stagflation. How to avoid? Hedge portfolios against commodity price shocks by diversifying across sectors. Maintain a balance of investments in inflation-protected assets like commodities, bonds, and real estate. 4. Black Monday, 1987. What happened? On October 19, 1987, the stock market crashed by 22% in a single day, marking the largest one-day percentage decline in US stock market history. It was fueled by computerized trading programs that exacerbated selling. Cause: program trading, overvaluation, and panic selling. How to avoid? Ensure a balanced investment strategy and avoid relying heavily on algorithmic or automated trading systems. Control portfolio risk through diversification and stop-loss strategies. 5. Dot-com bubble, 2002-2002. What happened? A speculative bubble in technology stocks saw the Nasdaq Composite rise sharply and then crash by 78% between 2000 and 2002. Many tech companies with little to no earnings collapsed, wiping out trillions of dollars in market value. Cause: irrational exuberance, overvaluation of tech stocks, and speculative investments in companies with weak fundamentals. How to avoid? Stick to investing in companies with strong financial fundamentals rather than hype. Be cautious of overvalued sectors and avoid chasing short-term gains. Focus on long-term growth. 6. Global financial crisis, 2008. What happened? The housing bubble burst in the US, leading to a global financial crisis. Banks that had overexposed themselves to risky mortgage-backed securities collapsed, leading to a credit crunch and a severe economic recession. Cause: excessive risk-taking by financial institutions, subprime mortgage lending, and overleveraging in the housing market. How to avoid? Avoid highly leveraged investments, particularly in real estate. Perform due diligence on financial products, and be wary of complex derivatives that carry significant risk. 7. European sovereign debt crisis, 2010-2012. What happened? Several European countries, including Greece, Portugal, and Spain, faced debt crises due to unsustainable levels of borrowing, leading to a loss of investor confidence and plunging stock markets. Cause: high sovereign debt levels, austerity measures, and economic stagnation. How to avoid? Be cautious of investing in countries or regions with high levels of public debt. Diversify internationally to avoid country-specific risk and consider the financial stability of different regions. 8. COVID-19 market crash, 2020. What happened? The outbreak of COVID-19 caused a rapid global economic shutdown, leading to a stock market crash in March 2020. Global markets fell by more than 30% in a matter of weeks, driven by fear and uncertainty. Cause: a global pandemic and economic shutdowns created unprecedented uncertainty in markets. How to avoid: keep a long-term perspective and avoid panic selling. Diversify investments across asset classes, including defensive stocks, bonds, and safe haven assets like gold. Be prepared for black swan events by maintaining an emergency cash reserve. 9. Cryptocurrency crash, 2021-2022. What happened? After a massive bull run in 2020 and early 2021, cryptocurrencies like Bitcoin and Ethereum experienced a sharp correction, with some coins losing up to 70% of their value by mid-2022. Cause: speculative trading, regulatory concerns, and overvaluation of crypto assets without intrinsic value. How to avoid: be cautious when investing in highly speculative assets. Ensure that investments have a clear, sustainable value proposition and are not driven purely by hype. How to avoid such crashes in the future: diversification. Always maintain a diversified portfolio across asset classes, stocks, bonds, real estate, commodities, and geographic regions to minimize risk. A well-diversified portfolio is less likely to suffer extreme losses during market downturns. Risk management. Use proper risk management strategies such as stop-loss orders, portfolio hedging, and rebalancing. Avoid overexposure to any single asset or sector. Avoid speculation. Avoid speculative bubbles by focusing on the intrinsic value of investments rather than hype or short-term trends. Be cautious of investments that seem too good to be true. Control leverage. Minimize the use of leverage, borrowed money, in investments. While leverage can amplify gains, it can also magnify losses, leading to catastrophic financial outcomes during a market crash. Long-term focus. Adopt a long-term investment perspective. Market crashes and corrections are a normal part of the market cycle, and the market tends to recover over time. Avoid panic selling during downturns, and stick to your long-term plan. Stay informed and educated. Stay informed about macroeconomic trends, financial markets, and risks. Regularly review and update your investment strategy based on market conditions and new information. 7. Use professional advice. Consider working with a financial advisor or investment professional who can help guide you through turbulent times and avoid emotional decision-making. By understanding the causes of past crashes and implementing strong risk management strategies, investors can avoid repeating the mistakes that led to significant financial losses in the past. If you enjoyed this video and found the information helpful, please give it a thumbs up and consider subscribing to our channel. We post regular content to help you make smarter financial decisions and stay updated on the latest investment trends. Don't forget to hit the notification bell so you never miss an update.